When you sell an asset for a higher price than you bought it, you make a profit. This profit is called capital gain. In India, the government taxes these profits through capital gains tax. This essay will focus on capital gains tax related to stocks and equity-oriented mutual funds. Understanding this tax is crucial for making smart investment decisions. Capital gains. Tax is categorized into two types: long-term capital gains tax, or LTCG, and short-term capital gains tax, or STCG. The categorization depends on how long you hold the asset before selling it. This holding period is the key factor that determines how your profits are taxed. Long-term capital gains tax, or LTCG, applies when you hold an asset for a longer period before selling. Short-term capital gains tax, or STCG, applies to assets held for a shorter duration. The definition of long and short holding periods varies depending on the type of asset. For stocks and equity-oriented mutual funds, a holding period of more than 12 months qualifies for LTCG. If you sell your stocks or equity mutual funds within 12 months, your profits are considered short-term and taxed under STCG. The holding period determines your tax rate. For LTCG on stocks and equity-oriented mutual funds, the rate is 10% on gains exceeding 1 lakh rupees in a financial year. Any gains up to 1 lakh rupees are exempt from LTCG tax. STCG on stocks and equity mutual funds is taxed at a flat rate of 15%, regardless of the profit amount. This higher tax rate for shorter holding periods encourages investors to stay invested for the long term. Understanding capital gains. Tax is crucial for making sound investment decisions. Knowing the holding periods and their respective tax implications helps optimize your tax liability. Long-term investments tend to be more tax efficient due to the lower LTCG rate and the 1 lakh rupees exemption. However, tax considerations should not be the sole driver of your investment strategy. It is essential to consider your financial goals, risk tolerance, and overall market conditions. Consulting a financial advisor can provide personalized guidance based on your unique circumstances. Remember to stay informed about any changes in tax laws to make the most of your investments.